first of all, Happy New Year to everybody. Hope everybody's New Year is off to a marvelous start thus far. So this is the REIN MultiFamily Focus Group meeting. We hold this every first Thursday of every month. So, make sure you mark your calendars, put that on, come back every month. Great meeting. And so we do this in conjunction with REIN. And my name's Brian Truman. I'm with SVN Accel Commercial Real Estate. I do nothing but help people buy and sell multifamily, and have for 8 years now. So very much enjoy it. But REIN is the Real Estate Investors of Nashville, the Southeast group. I think there's about 2,000 members of REIN, and so it's a very strong organization. Great place to meet other investors, other like-minded folks that are, first getting into multifamily, to people who are very experienced, to people who have been doing a lot of number of years. So REIN is, just a little bit about REIN is, what is there, Lisa, about 28 different meetings throughout the month. So I think memberships, a little, $2.99 or something like that, right, for the year. And there's like 28 meetings a month. Every county, different county has a meeting throughout the month. There's a women's luncheon that Lisa leads, that's for women investors. And then we have the multifamily one, and then they have a what they call the main event, which is going to be next Monday, right? And so here in Nashville, and they have classes at that main event for like 101, and then for investors who are more seasoned. I don't want to call them older, because that would mean me. That would be me. But anyway, so it's a great organization. You may want to check it out, from there. So. But we are going to jump into our topic today, and I had to call our speaker, Trey Palmedo, and beg him to come and speak, because I felt like he would be ideal to lead off the year going into 2024 to talk about what lending is going to look like coming into 2024. Trey and I have known each other for many years now, even before his current wife now was actually
first wife,
only wife, current wife and only wife. Sorry.
I am not old.
Yeah, he's not old, but his wife, existing, current, only wife,
right,
was actually our first admin Jan and I ever had. And so anyway, we knew Trey before that. So anyway, but Trey Palmedo is with New Point Real Estate Capital. He does agency lending, so Fannie and Freddie lending, and he's my go-to when it comes to Fannie and Freddie agency lending. So he's the one that I always send people to. The one thing Trey is not afraid to do is tell it like it is. And he's been very, very successful in his time. He was named one of the 30 under 30 here in Nashville last year. And so, he's got a lot of experience. In his new role with New Point, he actually kind of oversees all of the Southeast, where before he was more mainly just kind of here in the Nashville and that area. And so they've given him a lot more responsibility right now. But I do have to say, I don't know if I know anybody, bragging on him, but I don't know if I know anybody that knows more about lending than he does. He's very extremely knowledgeable. So that's why I felt like he would be the best speaker to have in January as we go into 2024. and talk about, okay, all right, Fed's decided, no more rate hikes. Come out and announce that maybe there's going to be 3 in 2024, right? So we're going to lead off and just kind of talk about, hey, where is lending? Well, let's just talk about the market right now, right?
Sure.
As you see it, and let's talk about where you think, not that, and this, I know this is going to be Trey Palmedo, 101, right? There's no crystal ball, but let's talk about kind of your thoughts leading into 2024, and are you bullish? Are you not? Where do you sit?
Sure. I like the fact that you pointed out this is going to be me, because we talked about this at lunch. We just had lunch, and I said, please tell them it's just my opinion, right? And I don't know. I don't, for sure know, but I have some good ideas. I think if you were sitting in my seat in capital markets for 2023, you feel like you went in after 2022 and 2021, which was just a crazy run at it. And then 2023 happened, and you just kind of sat there and you had a lot of opportunity to almost study economics and understand why the Fed was making some of the decisions that they were. For the most part, I like to think that I got a lot of the Fed decisions right, and what they were going to do, and we were able to kind of lend appropriately and guide clients into making decisions inside of the capital markets, apropos to the exact current situations that they were in. But 2024 feels, and maybe this is just the optimist in me, but it feels a lot different than 2023. It feels like a lot of the Fed decisions and their hawkish approach towards the capital markets, maybe not necessarily. I personally don't think that they're going to take a different approach. I don't think they're going to turn dovish. I don't think that we're going to start seeing rate cuts anytime soon. But I do think that the restrictive policy measures are more or less in place and where they want to hold for now until we see some of the data that I think they care the most about move potentially, I guess, good is bad, bad is good nowadays. But if some of that data were to kind of come in some, then I think that there might be some different decisions from the Fed. I think the biggest question that everybody has is, when do you think they're going to cut? And I'm in the camp that thinks that they're not going to cut in the first half of the year. I think that because Jerome Powell, who more or less is making all the decisions, was mentored, studied under, however you want to describe it, Paul Volcker. And Volcker made the mistake of raising, and then the second the data looked like he could even maybe start cutting, he started cutting, and inflation ran a little rampant. I think that Powell's main objective is to continue to rein in inflation. They've said over and over again that their goal is 2%. We're not there yet, and if you've been watching the CPI data, you can say it is falling, but it seems to be falling a lot less slower than it was when it was sitting at 8-9%. So I think it's going to fall, but I think it's going to be slow, and I don't think that the Fed is going to overreact to any sort of data. And I think that we'll have to see some negative data before we start talking about a rate cut.
So when you're talking about some of those rate cuts, and you don't think any time in the first half of the year, but then we're going to run into election season the second half. So where they've talked about maybe 3, where
it's interesting.
Do you think within the year they might do this?
Yeah, I don't know if they have to. I think that that's probably the most controversial take that there is, but I don't think that there's a mandate for the Fed to cut rates this year. Far as I can tell, job markets still seem to be strong. Inflation still seems to be ticking down, but it's still above their mark. And probably most apropos is they keep going on television and saying we're not done cutting or hiking rates. Stop talking about us cutting rates. It's a balancing act for sure. They understand that if the market were to think for real that there was going to be significant movement down in rates, then it could go gangbusters again. And if it does that, then inflation is going to run. So I think they are balancing the narrative and saying, we have not even taken rate hikes off the table, when probably internally they like to think that they've taken rate hikes off the table. But I don't think that they are having a serious discussion about cutting right now. And I don't. If everything that they've said for 2 years is true, if every piece of data that they're watching is what matters to them, if 2% inflation is as important as they've postured that it is, then I don't get the argument that we're going to see a rate cut anytime soon, because we're not there, and the data is not responding perfectly to exactly what they've said that they want to see. So I'm an optimist by trade, and I make my living on low interest rates, but I think that there is there's not, I don't know, it's tough to say this, but I don't think there's a great case for a rate cut right now. And I think that we as multifamily investors, owners, operators, sellers, for God's sakes, the sellers and buyers should start cheering for price stability and less of some magical world where we get back down to 3% interest rates.
Yeah,
that's a lot.
That's not going to happen.
Now, well, I mean, it could
soon.
if there was a major recession. Yeah. That's the case study for 3% interest rate. Like, the one thing I think we can all go to sleep a little. I can't solve the national debt, right? And if any of you have a great proposal, I'd suggest maybe walk it up to DC. But what I do think is good news is that we're really safeguarded against a recession right now, because we have rates that are higher than probably, I don't know, I should know this number off the top of my head, but let's say for at least they're the highest they've been since 2008. And that's our way out, right? Quantitative easing is allegedly our way out, and again, can't solve the debt, but that should be comforting, that a recession, theoretically, we have the monetary policy to get us out of a recession very quickly. So if you want 3% interest rates, it's probably going to come at the cost of a lot of people losing jobs. Yeah.
All right. Okay. By the way, as we go through, if you have questions, raise your hand. You don't need to wait till at the end. So, Mike, go ahead.
I'm sure you were going to get to this anyway, but the Fed clearly plays an important role in the debt markets. But as real estate investors, the Treasury yields are more so what drive our borrowing costs. And the 10 years moved substantially the past month or so.
Very, yeah.
How does that translate to real estate investing and lending?
Yeah, that's a great question. So I locked an 65, actually closed the largest deal of my entire career because of that drop. It was an $80 million acquisition, $67 million loan, and the borrowers went under contract at a 491 Treasury, and we locked a 389 Treasury. If you can picture this, the purchase price that they came up with, which was already a pretty substantially attractive cap rate, was when the Treasury was more or less 100 bips higher. Their interest rate was more or less 100 bips higher. So that was great for me because they were under an ironclad purchase and sale contract. What I have heard is that a lot of investment sales brokers and a lot of buyers have had their contracts either pulled or stopped negotiations on because buyer or sellers have decided to go back out to market and search for higher pricing because they're aware that the 10-year has come in 100 bips. So maybe this is a question that's going to be very common at NMHC. What happened to you when 3 weeks, 90 bips came in? I think we're going to get a lot of answers at the end of January. You got a good one? Basis point, sorry. So like an interest rate.
Yeah. Sorry, I was going to start off too so Trey is the king of acronyms, so I was almost thinking we ought to start off with a vocabulary lesson of all the different acronyms. So thanks for asking that question.
So bips being if it's 1%, it's 100 bips.
Basis
and rates came in. The Treasury, which is what most of all, you're either tethered to one or two benchmarks for most debt in commercial. It's going to either be the Treasury bonds of various different benchmarks or SOFR. And SOFR floats, but is
What
highly.
is SOFR?
Oh goodness, what does it stand for? I don't know. I was around when it was LIBOR, and that's my only old thing.
Yeah.
You know, it's like that's the only way I'm old is I was in the industry before it was SOFR and it was LIBOR.
Yeah.
But I used to say that watch when SOFR comes out, that it'll track the Fed fund rate almost identically, and that was the whole point.
Yeah.
That they already had fantastic control with monetary policy over the fixed rate. We needed to get off, well, not we, and I'm sort of speaking subjectively, but they wanted to get off LIBOR because London had more control over LIBOR.
Right.
But if the Fed could control SOFR as well,
Yeah.
then they could control both fixed and floating rate debt in the country. And that is a powerful monetary policy. All feelings of whether or not the Fed can control that or not aside, that is a very powerful. Anyway, we're going to find out at NMHC what happened, but for the most part, it's been a huge impact on the industry, and the acquisitions market has ticked up. The refinance market went just crazy, and the queues for the agencies. I last heard that if you submit a deal to Fannie, you're about 25 days out from a quote, and over my career, that's usually been like 24, 48 hours. So it's crazy right now. Like a lot of stuff's come in, and people are trying to take advantage of it. But then it ticked back up, so we'll see.
Yeah, because it's just barely. Today was 3.99 or something.
Yeah, 3.99 on the 10-year benchmark,
whatever. Yeah.
which is 3.89 is the lowest we've seen it in the past. I mean, I don't even know what time is anymore, but call it 2 weeks.
Yeah.
But still, I mean, also notwithstanding, that's 100 bips, 1% lower than where it was at its height, and where it touched 5.
Yeah.
Which is a scary number.
That's interesting what you said though. That about sellers going, hey, you know what? I'm going to go back out to market.
Yeah.
That's very troubling.
I mean, if you think about
But
what 1% less in debt payment is,
yeah.
it's almost the equivalent of 1% more in cap rate. It might actually just be the same, right? If I'm thinking, so if you think about what 1% more in cap rate is on a, NOI, it can be a material price difference. So there's, all right.
That's interesting. The Fannie's waiting 25 days.
Their queue is so long right now. It's crazy. It's crazy. Everybody's jumped in.
Yeah.
Because everybody doesn't know, right?
Yeah.
It could go back up.
Yeah. So, and that's enough to get the refinance market going crazy?
No, but I think it's enough to where if you were sitting on a, I'm going to try and not use, I was about to say UPB. If you're sitting on a balance where at a 4.99 Treasury, when you refinance, you have to put cash in, versus if you had a 3.89 Treasury, you're cash neutral. A lot of people were looking at the cash neutral saying, well, that doesn't feel good. I'm in this business to do a refinance to get cash out, and I can't do that, so it's going to go down. And then it goes up on you, and all of a sudden your refi, which has a ticking rate cap, which has a ticking maturity date, maybe you have some capital calls inside of your equity group that you owe money to. All of a sudden you go from cash neutral, now you're cash in by a mile, and people are talking about 7.5% treasuries and 13% treasuries on CNBC, and nobody's saying anything good. And then it comes in 100 bips, and you're like, okay, I'm break even at the blackjack table. I need to get out. I think it was the opportunity for a lot of folks to pull. I think 380. There's a running joke that I keep saying that the lowest treasuries make acquisitions markets, but 380 to me on the 10-year makes for an acquisitions market, and 330 is where I feel like we'd be back to 2009 activity. Not that it's the same, but I think it would feel rents have gone up considerably. Through all the interest rates hikes, it's important to remember that rents have also gone up a lot. So it hasn't just been, death to multifamily. There's been a lot of pluses in our industry, and we could talk about the tailwinds in housing are phenomenal. And if you're not bullish on housing, then I don't know where you're standing. But, capital markets, especially manipulated capital markets, are scary right now.
Yeah. That answer your question?
Yeah.
Mike? So.
Thanks.
I'll try and do the next one with less words.
Yeah, yeah. I know Tommy was going to be online today. Has he already sent us a question? If not, that's his cue.
No questions yet for me.
Oh, okay, all right, that's good. So, all right, so let's talk about who in here doesn't have real good idea of what agency debt is versus conventional. If somebody doesn't, well, let's cover that. So
Yeah, I can do it.
let's talk about that.
Yeah. So agency financing is a way to acquire or refinance multifamily housing. We are generally considered the best financing in the market and the most aggressive in terms of terms, but we also have a tighter credit box and look for a couple things that you might not see with like a local bank or CMBS product, life insurance company. The biggest thing for us is we're very asset quality based and sponsorship based. So we really care about the asset and who's running it. But we're non-recourse financing, so it kind of makes sense as to why.
Go ahead, Drew.
So with agency, obviously, you just mentioned asset quality. Obviously the 90 for 90 occupation and all that kind of stuff are occupied.
Yeah.
Matters. But
90%, 90 days.
Higher rates, more uncertainty. Are they even stricter on their quality-based criteria, or
Yes.
is it kind of the same as it was in 21?
Well, so what's been the theme from both agencies for 2023 was a much higher quality test for asset quality and engineering reports, and it's always these things are they make so much sense in hindsight. But I'm gonna run into the weeds a little bit, but it'll make sense, I hope. There was a lot of bridge financing done in 2021 and 2022, and that bridge financing was acquired, call it Class C- to Class C+ assets, and a lot of owner-operators took a business plan to their lenders that said, we're going to take these assets over. They're not distressed, but they have a I always try and find the right words for this stuff. They have a lower paying tenancy, and they have maybe some retro units. It's not retro, there's another word for it. Classic, thank you. Classic retro, disco ball. They have classic units, and
Not that old to even know what
yeah,
that is.
yeah, right. They were way before my time, Brian. and so folks went in and they bought this stuff and they started implementing their business plans, and all of this stuff was bought on floating rate debt with rate caps. When it was all bought, it was 5 bips of SOFR, and people were buying like 275 caps, and they were already buying deals that didn't have 1.0 debt service coverage ratios. So maybe like 20% of people got that. But the long story short on all that is people were buying deals that that didn't service their mortgage debts, and they were using a rate cap which prevented the interest rate from going higher than a certain amount. But they were very much reliant on the fact that SOFR at the time was just 5 bips. Then maybe their rate cap was 2.5 bips, but even when it was at 5 bips, they weren't necessarily covering the mortgage. Maybe they had like interest reserves or things like that to actually pay for it. Because, I think we can call a spade. People were buying this stuff for a lot of money, because the idea was we're going to go in, we're going to put $10,000, $15,000, $20,000 a door into each door. We're going to take the asset over, and in doing so, we're going to be able to raise rents 30 to 40%. All right, so here's what happened that's the problem. We got into, a lot of this stuff got made. It was something like 500 million or 500 billion. It was almost $500 billion. It couldn't have been that much. That seems ridiculous.
Yeah.
I don't know. Maybe it was no, because 500 million seems too low. Whatever it was, there was a lot of this stuff done on bridge debt, and folks got into their business plans, rates blew up, and lenders stopped granting withdrawal requests. They started saying, we're no longer going to fund your CapEx plans because you're not meeting your milestones that are inside of your loan docs. Well, it was kind of a chicken and the egg. Owners and operators saying, we're not meeting our milestones because you're not giving us the CapEx dollars that were promised to us to go in, rehab these units, and up our rents 30% and seek new tenancy. The lender said, well, look at the capital market situation. You could barely afford your mortgage when it was 5 bips. Now we've run up to 250. No one saw this coming. We can't be putting out more money, right? So this has been a very, very contentious problem with bridge debt borrowers, and the agencies know this, and so they've said a lot of people have bought class C- stuff that wasn't inside of our credit parameter. It was inside of a bridge credit parameter. They've bought it, and they were supposed to implement a business plan that didn't get implemented. So we need to take a more hawkish approach towards asset quality through our engineering reports. And they have not been shy about this ask, right? They've come to all of us as lenders, and they've said hyper scrutiny on your engineering reports, hyper scrutiny on the assets, and don't get it wrong. So in the world of engineering reports, where the agencies rank them on a 1 to 5, 1 being, basically new build, perfect, pristine condition, 5 being, I hesitate to say falling apart, because 4 is almost in the realm of falling apart. 5 is like it's barely there. For the first time in my career, I've seen 2 4s, and I've never seen a 4, right? So to that point, and I'm not the only one. Like, this is happening all over the industry. Engineers are cracking down on their reports to Fannie. And it's killing deals, because when you get a 4, it's a dead deal. They'll kill it in the spot. So it's a good question. Yes, and yes with an exclamation point.
Yeah. So let's back up. Just go ahead, Michael.
What's killing these deals? Like, what are they looking at?
It's all kinds of stuff, and I think it's maybe a combination of the narrative is very strong from the agencies of look for this and don't miss it, and look for this again. I think that's part of it. People seeing stuff that, when you have the magnifying glass on you, you're catching more. But I also think that it is the kind of problems that come along with C-, C+ assets. I'm a firm believer that there's no D asset, because if there is, it's usually vacant, and we're not talking about value add. We're talking about reconstruction. But in the C- and C+ space, you do see a lot of exposed wiring is a good one. You see a lot of foundational problems. That's a big one. And you see a lot of water leaks. You see a lot of what we call life hazards, where maybe you have huge potholes, or you have misaligned concrete in ADA spaces. Some stuff that you feel like would be a small fix, but a lot of people have just kind of thrown their hands up and say, we're not taking care of this stuff, or we're lipstick on a pig with it and calling it taken care of. But I would say the scrutiny is part of it, but also a lot of the assets that have been coming across the space are people trying to dump their C-, C+ properties where they're in not so great bridge positions, and it's tumultuous with their lender, and they're trying to dump it on Fannie and Freddie, and they know to look for it because they're the most sophisticated capital markets group in housing, and they're ahead of it.
Yeah, so let's back up just a tad too. So when we're talking about agency debt, when we're talking about Fannie and Freddie, and Trey did a great job kind of describing it. He mentioned non-recourse. Does everybody know what non-recourse is?
It's cool if not.
Yeah. If you don't, that's fine, right?
Or I can just say it.
Go ahead.
Yeah. Non-recourse debt is it's easier to say what recourse debt is, and recourse debt is when your personal financials, your personal bank accounts, your personal property is collateralized in some way against a loan. A perfect way to think about this is just a normal bank loan, right? You go to a bank, you borrow money, they say, what's your financial wherewithal as a person, and if you default on this loan, we're going to come get all that stuff. In non-recourse financing, what collateralizes the loan is the actual asset. So we're doing, again, a little bit higher scrutiny on a credit box, but we're looking at not only the asset, but the person that's going to run the asset. That's almost like part of our collateral is your skill set, your tenure, your financial wherewithal. Even though we don't have access to your net worth, if there are carve-outs, like if you commit fraud or burn it down, but we don't have access to your net worth if something goes wrong. But we want someone with a high financial wherewithal because that does speak to their ability to operate the asset.
Yeah, so on agency, there are some requirements, right? You have to have a certain net worth, and you have to have 2 years experience, so forth. But what Trey, when he was talking about the environmental report, is agency is, like Trey said, they're much more picky about you, the borrower, but also the property. So you think about it, you think, okay, hey, I get this property under contract. I'm gonna bring in my inspector, come inspect the property, run through it. That's great. But on the agency side, then they bring in their own, which is the environmental guy that's going to come in, and so after you bring your own inspector to come in and inspect the property and look at everything, do all that, agency's bringing in their own person, right? This engineer. So you get this engineer report that can be, you that in here that have been through agency, I know Pat has, some of that, you get back this report that's like this thick, right? And they go through, everything. And I know, like with Pat and some other folks, clients that I've worked with, when they're doing agency debt, I can go with the client, I can walk that property before we even put it under contract, and I can pick out, because of the number of agency deals I've done with Trey, and that is, I know exactly what those environmental guys or gals, I know exactly what they're going to look for, right? So I can point those out, but that's when he's talking about the environmental reports. That's what he's talking about, is it's that additional layer that agency, Fannie and Freddie, required, for the lenders to have this environmental report. So it's an additional layer of inspection on that property, and that's why, between that and the requirements of having, the experience and then having the net worth, that's why Fannie and Freddie take back like 0.0000001% of properties, right? Because of how strict. But like you said, it's usually the best debt out there, and with having non-recourse, you can't ask for better on that. So
How
go
much
ahead.
better?
Well, the non-recourse is material. Banks typically offer. So we do a 10-year with a 30-year AM, and we do a 5 and a 7 as well. But the 10-year is just our most standard product. So we do a 30-year AM, where banks typically do a 20-year AM. We're way higher up in the stack. We're like 75% on a refinance, 80% on a purchase, where a life insurance company is typically going to pop out at, call it 65, maybe 70% if they really, really like the asset. Interest rates wise, we're usually 30 to 40 bips inside of banks, although right now I think we're a little bit more than that. IO periods are considerably longer for us. Banks may be a year to 2 years. We can be as high as full-term IO. But typically, if you're a higher leverage deal, interest only, sorry, yeah. If you're a higher leverage deal, then we're going to be about 5 years of IO on a 10-year product. So, most of the, I think most of the term metrics, we're usually beating everybody. I think life insurance companies at the beginning of the year can be more aggressive on rates than us. They usually will be about 30 to 40 bits inside of us for the first, call it 3 months, but by the time, it's always a joke. It's like if you ever find out that you're competing with a life insurance company from January to about April, you're going to lose. You're going to lose. But the beauty of that is they don't really go after the stuff that most of us do, right? They're going after like the 400 unit Class A luxury in one of 10 places. So that's not my area. And so I would say that we're usually better than everyone in some capacity. Where our pain point is we take our loans and we sell them off in the market as commercially mortgage-backed securities. Kind of. With Fannie, it's sold off as a commercially mortgage-backed security. With Freddie, it's put into a K-pool. Actually, the CEO of my company is David Brickman, and he was the former CEO of Freddie Mac, and he created the K-pool. So that whole invention was his. He holds the patent for it. And So they do a pooled loan, but what that causes is prepay. So banks most of the time don't have prepay scenarios. We have prepay, and our standard prepay is yield maintenance. On a 10-year product, it's debilitating for 4 years. 5, 6, it's painful. 7, 8, and 9, it's relatively fine. Where we try and hurdle that is we allow for assumptions. So if you go and sell your property, and maybe it's in year 2. I also should say, generally speaking, people do not sell their property in the second, third year when they put a 10-year loan on it, right? Generally speaking, most people go into stuff and they have a pretty good idea of how long they're going to hold it, and they're building a term product to match that business plan. But in the instance of, I bought this for $10 million and Ford moved in and started building a battery plant next to me, and all of a sudden, my rents are $600 higher, and I could sell this for, what did we buy it for, 10? We could sell it for 20, and it's year 2, and you want to sell. We allow for an assumption. So because that Y2 sale would be pretty rough on yield maintenance. So, and we do supplementals. So you can actually, if you were to say, Trey, we bought this for $10 million and now it's worth 20. It's been a year. Ford just moved in a battery plant. You can actually come on top of that and leverage back up to 75%. So I can give you $5 million in cash out, which I should also say is probably one of the most attractive things about agency debt is that we are very friendly to cash out. We use debt service coverage ratio metrics. We're trying to cover a 125 in most instances, and we'll absolutely give you cash out of your deal. Come get the dollars from me.
Is there another qualification process for the assumee?
They have to qualify for agency debt. And it's unique in the sense that it's up to the lender's discrepancy. So I've seen these things like go as quick as 30 days, and sometimes they'll go as quick as 6 months. It's really all about the relationship with the owner and their originator. But I've always felt like I've done a good job when those have come to me. And
Rolling stuff, Lisa.
when I just wanted to show off my boots. So yeah, it's if you can qualify for agency debt, you can qualify for an assumption. That's the best way to look at it.
Yeah. The question?
Yeah, we actually have 2 from Tommy, so maybe
Oh.
one and then the other.
He's
What
making
are
up.
the industry implications for some financial entities that are under investigation by Fannie Mae, Freddie Mac?
That is not a fair question, Tommy.
Looking at Meridian Capital.
Yeah.
Do we expect agency standards to stay same or get strict ER?
Stricter. ER. Strict ER, yes.
Is that an acronym?
Yes. Tommy may not know this, but it's worth disclosing that the parent company, not parent company, this is not the right word. I need to be better about this. This is very important what I'm about to say, because I think I have to say it. A large investor of ours is Meridian Capital. Has everyone or anyone heard of Meridian? All right. Okay. So if you've heard of Meridian, if you haven't heard of Meridian, Meridian is the largest capital markets brokerage group in the world. They are crazy. They do like $40 billion a year, and they are under investigation by the agencies. And it is no secret. It is public, and I'm not 100% sure all of the details behind it, but they are an investor of ours, and that is it. They are a large investor, and I think that that's fair to disclose, but that is it. That's it. So what do I think are the standards? If you are a mortgage broker, it has become considerably more difficult to be in your line of work. The agencies no longer allow for mortgage brokers to represent financial documents to lenders. This is a fundamental change from forever. And as originators, we now have to receive everything direct from borrowers. And if you're a mortgage broker, it is a very hard sales pitch to say, pay me 1% to introduce you to somebody. So that's the biggest change. And then yes, it does feel like that. It does, yeah. It does feel like there's more scrutiny across the board. Yeah. I'm gonna go with that.
All right, and then second question. What is the future for some alternative lending arms that have a large portfolio of bleeding, defaulting bridge loans like Arbor Capital? What options do they have to navigate this?
Who asked that?
Tommy.
That's great. So Arbor, for those of you that don't know, is one of our largest competitors. And a couple of their originators also called into the market when the whole Meridian thing went down and said that NewPoint's going out of business, so which was fundamentally untrue. And we could not be it's so ironic with this whole Meridian thing is that we were probably the least firm exposed to the whole thing. So I don't know how much of this is public, so I'm going to try and be careful. But there was like 50 loans that were called into question, something like that, and we had like one. So it's we were the least exposed of the exposed, and almost everybody was exposed, by the way. So everybody, the initial feedback was, from every single client that I've ever talked to was, I heard you're going out of business, and I was like, oh, from who? Would it happen to be one of my competitors? Yeah. But yeah, so anyway, so gloves off, Arbor, no, they're all fine, I guess. Whatever. I know a bunch of them. All the originators, we all know each other. I think there's only like, I don't know, maybe like 400 of us in the whole industry, maybe something like that. I don't know, maybe it's like 500, but there's really about like, I don't know, 50 of us, and I'm not going to be braggadocious, but there's only about 50 of us in the whole country that have done over $1 billion, and I've done over $1 billion. And I am the least cool of that group. Like if you meet all of the originators across the platforms that have done a lot of business, it's a lot of eccentric personalities, and to say the least, and so. It's an interesting dynamic. So I don't fault them for saying those things. But what's going to happen to their platforms? I don't know. I shorted Arbor stock. So that's all I'm going to say.
He says,
there you go, Ivan.
He says, sorry to put you in the hot seat, Trey, love you.
Hey, Sammer, did you have a question? I saw your hand up a minute ago. Oh, he answered it already? Okay. All right, good. Any other?
SBA versus agency.
Yeah, I don't know a whole lot about SBA. I know what you're talking about. SBA financing is small business financing. I really don't know that much about it. I can't talk intelligently of it. I really don't know. I'm sorry.
Lisa can.
Yeah.
Now, the reason I mentioned that is we, besides having our real estate company, we own a business brokerage company. So we're kind of like the eHarmony of business brokerage. We marry up those buyers and sellers. That's supposed to get a laugh, but I guess not. Okay. Anyway, so SBA, we deal with SBA a lot on people who are buying businesses. So yeah. So we can talk about that offline, but yeah, from there. So, Michael, question.
For the past year or two, there's been the talk of the ticking time bomb of all that bridge debt.
Yeah.
And it's even quantified. This is what's maturing in the next 2-3 years.
Mm-hmm.
Is it too early, or is it never known how many of those people are currently refinancing with the drop in rates? Like, did we dodge the time bomb, or is it too early to tell?
Well, I think it's early enough to tell that right now this doesn't do it. There are some markets that I could not.
I mean, it's not enough.
Right. It's not. Yeah. It's not enough to dodge it. Yeah. I think that's probably. I mean, I know this because I was trying to refinance a lot of that stuff at a 3.30 Treasury 8 months ago, or whatever it was, 9 months ago, something like that. So, and it still wasn't working. A lot of the problems with the bridge financing is it did not come close to meeting its objectives with rent increases, and there's a lot of economic theory behind this. So you're going to have to give me a little bit of reach here, but there is a theory in housing that the more production you do of Class A multifamily, that it lowers rents across the board, right? So even in Class C, and you may say to yourself, well, that doesn't make sense. Like someone who lives in Class A, probably barring some sort of major event in their life, are not going to live in Class C. So the supply-demand factors are almost separated from each other, right? But the sort of trickle-down effect of, not economics, but trickle-down effect of supply is that you could also argue that a Burger King burger is not the same as a McDonald's burger, or it's not the same as a Wendy's burger, but the more burger joints that come on the scene, the more, or the less a burger is theoretically going to cost. Class C plus that has been converted to Class B minus has taken a considerable hit in rents across the board. Class A has taken a monumental hit in rents across the board. And again, we can use these numbers when we're talking about 4 to 6% rent decreases, right? There are some cities that I cannot imagine owning in right now. Houston is one of them. Phoenix, incredibly difficult. God have mercy on anybody in Florida, which is crazy because 2 years ago, every single person would have told you buy in Florida because everybody's moving there. And everybody is moving there. They have a phenomenal demand factor. They have $2,000 to $3,000 a door in insurance costs. It's a very, very difficult place to own. Mississippi and the coastal areas having similar problems. Louisiana is having insurance problems. That's a big, big factor in our industry right now is insurance. But there's been a lot of supply come online. And it sort of makes sense. In 2020, 2021, capital became prolifically cheap. A lot of developers grabbed onto as many dollars as they possibly could. I don't know if you've looked around, but our city's national bird is a crane, and it seems to be that way in a lot of places. And there's been a lot of product come online. But it's interesting because the exact same thing that drove a lot of product to come online, which was artificially cheap capital, has also caused developers to go, virtually across the board pencil down, right? Nobody is building right now, especially new starts. Starts are phenomenally low. And I'm just talking about multi. We don't even, single family is a whole different realm, right? But that is, you want a bold prediction, 2025, 2026 are going to be insane years for rent growth because the demand problem of multifamily real estate has not gone away. The fundamentals of housing in America, for a bullish stance on housing if you're an owner, if you're a buyer, it's not so bullish, right? But for landlords, for rents, for bottom line NOIs, sans insurance, there is a phenomenal case study, a phenomenal case to be made for housing for the foreseeable future. Labor problems do not seem to have any room to end, right? I don't see anybody planning to go out and swing a hammer in 100-degree weather for $10 an hour, especially at scale. Construction costs, I was eating breakfast with a developer this morning. It's phenomenal stat. There have been, in the last 75 years, there have been 2 years where the cost of sticks and bricks have gone down. In all 73 other years, the cost of sticks and bricks have gone up. So construction costs aren't going anywhere. Labor costs are just going to get more expensive. Right now, I'm not going to say it's company because it's not fair, but they are in the top 5 largest home builders in America. They cannot get out of the ground on a townhome development. Not a single townhome, single family townhome. They cannot get out of the ground for less than $165 a square foot. $165 a square foot. This is the most, and again, I don't want to say its company's name, but cookie cutter, we can do this 100 houses a minute group. They have every bit of economies of scale that you could possibly imagine, and they cannot get out of the ground for less than $165 a square foot. And something I think that we have a tendency to forget in real estate is that it falls down at some point, right? Houses don't last forever. Apartments don't last forever. The amount of problems that have come, talking about engineering quality from 1970s vintage, that people didn't even really think were problems because their case study for 1970s vintage, when it was bought at scale, was 15 years ago when we were buying product that wasn't 50 years old, right? So now that product's aged and those issues have come to light and they're expensive. And if you have an expensive problem inside of housing module, you have one of two choices. You can either charge more to live in it, or you can knock it down and build something else there, and neither of those options are cheap. I forgot the original question, but whatever it was, here's my point. Here's my point. Housing has extremely strong tailwinds behind it. There is not a really good argument as to why housing prices could go down, other than such an artificially high capital markets that it decimates jobs to the point of where people can't afford their mortgages anymore. And then I would ask you, if you can't afford a 2.5% mortgage, where are you going to go? But don't end on that, because that sounds gloomy, you know. Yeah, I knew it was coming.
On the back of all that, then, from the investor side, because for me personally, I have definitely moved to like from B to B plus or A minus, right? So when you say that's how you advise clients,
For sure.
maybe it's not advice.
Yeah. I've always said I'll close your loan no matter what. You know? but just pay me. I'm a sucker for dollar bills. I think that's the point, right? Like, and it's also, it's not me. The whole market's talking about it. 1985 has become the new 1970. And 1970 was the only buzzword you heard in 2021 and 2022 because you could pick it up for $65,000 a door. Like, if we could pick it up for $65,000 a door and we put $20,000 a door into it, how could we possibly not make $20,000 worth of improvement on the same 750 square foot layout that everyone else has and make it look as close as possible to something that just costs $240,000 to come out of the to come out of the ground, right? But here's the challenge. I am extremely good looking on the outside, but I eat too many cheeseburgers, so the inside isn't that great. And that's the point behind some of this vintage stuff, is that you can put granite countertops and new wood flooring, but you can't take care of cast iron pipe. You can't take care of aluminum wiring. These are extremely difficult challenges inside of plumbing and electrical and mechanical. You have a 20-year-old AC unit, it does not blow cold. And that's the part where you don't factor in the fact that that's going to be another $5,000, or you're going to be ripping cast iron, or you're going to be ripping broken PVC pipe when it was just implanted in, or that stuff where they did it kind of together, right, and whatever it is, or the roof styles from back then. I have no idea who the architects were, but Lord have mercy, what book did they look at and go, this is a good idea. The flat roofs, or TPO or whatever. All of those challenges from that vintage are rearing a very ugly head right now. So I think 1985 is the new 1970, and then there will be some kid up here in 15 years saying 2000 is the new 1985.
But Trey, that product is necessary in the marketplace, right?
Yes.
Because it is affordable housing.
Well, affordable being subjective, right? Like, you look at a lot of people and you say, because what is affordable, right? Like, we're charging $1,100 to $1,200 a month for 1968 product that's got granite in it, and that's not affordable to a lot of folks. Like, the affordable housing problem, I mean, that's a whole nother hour, right? And it's something I'm very passionate about. Like, it's probably the thing that I care the most about in all of my career, is how to solve the affordable housing crisis. I have a lot of ideas. I don't know if they're any good or not, but I can tell you this: as of right now, there's no conventional way to do it. It's going to have to be a capital solution and not a developed solution, if that makes sense.
Yeah. Sammer.
So my question, you were kind of alluding that a lot of the distress on the bridge debt side of things is going to come from C-class assets over the next little while, but it's clear that capital is shifting like towards B-class and A-class assets.
Mm-hmm.
So the question in my mind is, like, who is going to buy these distressed C-class assets, and how is that problem solved for? And then also, like, maybe there are the broken pipes and the aluminum electrical that you have to spend $20,000 replacing, but like, what if you budget for that and lenders lend to those metrics? Like, will they then lend according to higher CapEx expectations that don't return rent dollars, basically?
There's a lot of answers in that question. For one, who's going to buy it? I mean, it's free market, right? There will always be a buyer, presumably. I'm a big proponent of housing as sort of, I don't know. This is not a bold thing to say. Housing is an economic necessity, right? It's one of those things like, who's that guy that's always like, I only buy products that relate to birthdays and death because they're always going to happen. My thing is like, someone's always going to want to go somewhere when it's cold outside or it rains, right? So housing is going to be around, and that's not crazy, but who is the buyer for that kind of product? I think the question, and I'm not undermining your question, but I think the more important question is, who is the seller, right? Are you selling at a loss to your equity, or are you selling at a loss to your lender, right? Those kind of questions have more of an economic impact on all of it, because I tell you, if you tell me who's your seller, I'll tell you who's your buyer. You know, if you tell me that it's somebody that bought it for $60,000 a door, planned to put 20 in it, lender backed out of CapEx, and now they're on market for $30,000 a door, I can tell you who your buyer is. But if you tell me that they're out looking for, because they bought it for 60 and they're out looking for 70, I don't know if I can tell you who your buyer is anymore, especially in that vintage. And who's going to lend on it is another big question. A lot of these groups, Tommy was alluding to one, is a lot of the groups that did a lot of that bridge debt, they're having distress in their portfolios that's being held up by rate caps. And those rate caps are going to expire. We talked about this, but those rate caps are going to expire, and that chicken's coming home. Whether or not that chicken's coming to the barn, it's whether or not the interest rates drop before it gets there. That's the question. That's the question that I really.
Well, and I think what Michael was talking about is there's been a lot of numbers thrown out there that come, 2024, that there's like $285 billion worth of bridge debt, or maturities in multifamily that are going to be coming due, and a lot of that was purchased at 3% interest rate, or 3.5%, right? Well, now what are they going to do, right? Are they going to go, okay, let's see, we're going to have to ask LPs to bring more money into the deal, or are they going to have to sell, right? So, that's kind of what I was alluding to.
Well, and we've had a unique capital markets solution that, again, it did not take a crystal ball to say this, but I tried to call early on and tried to implement it as part of my practice. It was basically the only reason that I got to do transactions this year was a whole new round of capital that had never really been talked about before came on board, called rescue capital. And so essentially what happened was a lot of pref providers who are allowed to lever down to a 105 DSCR came on board and said, your asset cannot cover at a neutral amount, right? Your cash in today, but we'll slug another X amount of dollars on top and you'll be cash neutral. But in doing so, they made those assets perform at 105 debt service coverage ratios. So there's not a whole lot of room for the equity. So if you're an LP in a deal, especially the GPs right now, you're probably not getting a whole lot of distributions on your assets. I'm personally not very bullish on the 1970s stuff. I just don't see how much more, to your point about affordability, I just don't see how much more you can ask of somebody in a class C plus area, unit, etc., how much more you can ask them to pay, right? Like at some point, there's a physical barrier, and my generation was one of the first generations that became comfortable with the idea of paying at least 50% of your after-tax income for renting. And if you think about what that is, it's already crazy. So when you start asking for more, it becomes almost like I can't. Not that I don't want to, not that I won't, not that I'm going to hold this back on you, but if you run any credit parameter, any financial metric on me, I physically can't. And
what if that's just a loss to lease play then? Like if they're just severely under currently.
Yeah.
Somebody's coming in mainly just to bring them up to market.
I mean, that's a huge thesis from 2021 and 2022 though, right? And it's sort of, I mean, there's a great argument for it, but there's also there's been a lot of instances where it didn't work.
Yeah.
But that was, yeah.
You've talked a little bit about Nashville and talking about all the stuff coming online. I was seeing something, it was probably Nashville Business Journal or one of the other places predicting that rents are going to because so many are coming online, so many apartments are coming online, that it won't be able to hold up the rents for a while.
Yeah.
Do you feel, at what point do you feel it'll be at? Will it go down $100, $200, or $500?
Well, I think it's easier to quantify in percentage, but
Okay.
yeah, I mean, I personally, so my group, we sit around and we print off CoStar reports and chunk paper balls at each other all day, right? We're boring. And so I've read almost every single market in the country that has a spotlight on it. And I don't mean like that. That's not limited to just the big 10 or, probably something like 75, 80 markets. And it's really interesting to see in pretty much every single large market, you can expect rent decreases in 2024 and probably 2025. But rent has always been a huge lagging indicator. Another problem with rent is that it's extremely difficult to measure what rent actually is, especially in the different metrics that the Fed uses. They look at rent as a basis for that moment, whereas they look at rent for a basis for that year, whereas rent actually is changing every month because people sign leases at new lease amounts. But that data doesn't get factored in, which is crazy because it's so easy to pull from Yardi. But that's been a big argument on our side of the business of doing it. But I think generally speaking, you're going to see a decline of rents, and I may have already said this, I apologize, but somewhere from 5 to 10% for larger markets. And the larger the market, the more. Houston, Phoenix, Miami, terrible situation, not getting any better, all for different reasons. But they're boom busts, and they're known to do that, right? I don't think Nashville's a boom bust. I think Nashville got a lot of build in it. But in almost every single one of these instances, again, kind of going back to tailwind and not being the guy that just comes and preaches doom, because I'm actually on the opposite side of doom. It may not sound like it, but I actually am 100% riding the jet of commercial real estate sans office. But the lack of development that's occurred this year, last year, because of the capital market situation, will allow for that catch up. And the people are overbuilding because they see the demand coming, and the demand is coming to the southeast.
Well, I can understand that. I mean, when I was much younger, there was an overbuilding in a certain time frame about the 1980s or whatever.
Yeah.
And it allowed me to get free rent or negotiate with apartment complexes. They would send me a rent increase, and I'd say no.
Yeah.
And they'd say, well, you can't do that. And I said, I just did.
So this is probably TMI, but I travel a lot, and I'm trying to decide. Okay, I'm going to say it. All right. So I travel a lot, and my wife and I, we travel with our children nonstop, and we own a couple different houses and a couple different places that we go to. But for the past year, I rented, I'm going to say it, 5th and Broadway. And I rented the penthouse up on top, and it was like $9,800 a month. And they sent me a renewal, and I said no, because my sister and I were going to get a house in 12 South, and it went back on the market like 30 days after I said no for $7,400, and I was like, you assholes. like if you would have offered me $7,400, I might have said yes, but so it's on them. But, anyway, that's going to be thematic, especially in that class, the Class A luxury multifamily in the large markets. They're going to take a huge hit this year, but those firms don't care. They bought that. Do y'all know how much they bought 5th and Broadway for? $750 million. It was the largest transaction that ever occurred in the state of Tennessee. That's almost they went on market for $1 billion on Broadway. $1 billion to stand next to Kid Rock. It's a horrible deal. Sorry.
Funny. Yeah. So, we've learned a lot so far.
Oh yeah,
that's for sure.
So you talked about the major markets that you're not too excited about.
Mm-hmm.
What markets are you excited about?
Oh, anywhere where someone will give me a deal. No, I think I really like the rural markets outside of the major markets. I think that's like where it is right now. At some point, like the whole narrative Go ahead, sir.
No, I didn't want to interrupt. So you just heard that? So when we call you about a deal that we have that's right outside, yeah, answer our call.
Yeah.
Yeah.
Is Martin,
Yeah.
Tennessee considered?
It's considered rural, that's for sure. Yeah.
We have many other than that one, Michael.
Sorry.
But thanks for bringing it up.
Great property.
Yeah.
Yeah, you know, for the most part, like some of them are, like we were talking about this, Clarksville is a little, I don't know, someone probably owns here in Clarksville, so be quiet. But that's going to be a tougher market. A lot of supply, right? That's their issue, is just a lot of supply. But yeah, I mean, if you can get into a rural market, I think at some point the narrative of the millennials are always going to live in apartments is eventually going to have to go away, right? Like I'm a millennial and we're on our third kid. So it does, you know, that narrative's a little overplayed. And then, so they're going to be looking for less city areas, right? To raise children, a child. I think once you get into 2, you have to get a house, but to raise a child, there's going to be some comfort in 2-bedroom apartments. You know, the Gen Zers are very mobile. They're going to want to stay in multi. I'm super bullish on multifamily, so I think you just have to pick where. You know, I am bullish on Class A too. Like Class A downtown, really well located, experience-based real estate. It's just there's a lot of it right now, but there's a lot of Gen Zers and Gen Xers, and they're gonna get out of college and they're going to want to live in these places, and they're all moving to these major cities. Yeah, so I mean, I don't know. I'm bullish everywhere.
He's bullish on Nashville.
Yeah, I'm bullish on Nashville for sure. Yes, ever since Ford announced their new developments down there. So I was sitting at a dinner one time in Louisville, Kentucky, I think, and a Politico from E-Town, Elizabethtown, was there, and it was 1 week before the announcement, and he said, hey, watch out for Elizabethtown because there's about to be a major announcement and everything's going to go nuts. And it was the Ford announcement, and it was like every single person who owned there had just hit the lottery, because people that were transacting in E-Town were people that had they were kind of newer syndicators that just they could get deals there because it was a transactional city. And then this announcement got made, but then simultaneously it got made for Memphis, and they also didn't they do the big revitalization of downtown, or in the process of? I think they're putting $800 million into downtown.
In the process.
Yeah.
Of it.
So bullish. Why not?
Lisa doesn't want you to talk about that though. She's trying to keep it under wraps so nobody else will know it. So, yeah.
Yeah.
Yeah. So let's talk about just going back to agency.
Okay.
So we talked about, you know, those that want to get agency. You have to have a couple of qualifications, right? And you have to have 2 years of experience. You have to have the net worth, okay? But let's talk about the way around that.
Oh, yeah.
Yeah.
And you know, the way around that is you can get a sponsor. So let's talk about that.
Yeah.
Talk about sponsors and what those requirements and all that is.
Yeah, and these are groups that are perfect to do things like that. So we do have some requirements to borrow from agency. Your net worth needs to be equal to or greater than the value of the loan that you're borrowing. Your liquidity needs to be 10% of the loan, and you need to have owned multifamily for at least 2 years, owned and operated multifamily for at least 2 years to borrow from us. That said, this is not necessarily you. It's the partnership, the owners and the operators, the GPs and the transaction that are all measured in aggregate. So let's say that you want to borrow a $10 million loan, or you want to borrow a $10 million loan, and you and your buddy have $5 million net worths. You have he's got $800,000, you have $200,000. You're going to raise all the money to purchase it, and you know, this is your first multifamily project, and he's owned for 3 years. He's got a 35 unit in, not Clarksville, but Franklin. He's got a 35 unit in Franklin, and he's owned it for 3 years. So, and I should have done it where you bring the net worth, and anyway.
Yeah.
So it's all counted together. So his experience is what's going to get you for the experience. Your combined net worth is going to get you to the $10 million. Your combined liquidity is going to get you to the $1 million. We're looking at it as an aggregate group of sponsorship for our financial wherewithal, and then one of the people have to have the 2 years of experience. It's not like 1 year, and add them together. But that's why it's good in these kind of situations where you may be taking something down. You might look at that and say, I've got X, Y, Z. I've got the deal. I've got a good track on the equity. I want to operate the business plan, but maybe I don't have the experience, or maybe I don't have the net worth. Maybe you're going after, maybe you do own a couple of $5 million buildings, but you want to go after something bigger, the $15 million range. So you can get someone who has what you're lacking in to come into your partnership, and they can help satisfy the requirements for agency transactions. And it's a very powerful networking business/tool that all of us in the industry utilize to take next steps in our career, next steps in our ownership, next steps in our operating, and next steps in our skill sets to kind of, I don't want to say loophole because it's not really fair. It's not a loophole. It's a strategic partnership to accomplish a shared vision. Hell yeah. Thanks.
Right. Yeah. So everybody understand that? Everybody get that? Okay. All right. Yeah. Because a lot of times, we'll have people approach us and say, "Hey, I found this deal. I've got the capital, but I have no experience. Now what?" Right. So, just what he just went through is the way to get. I don't even want to say around that. But, but get somebody to
strategic
come in,
partnership for a shared vision.
There you go.
Yeah.
That one.
It's like Kendall Roy.
Yeah. So there are
very limited joke pool.
Yeah. So there are ways to bring somebody in to that partnership to accomplish your goal, right? So don't always look at because I think a lot of people look at agency and they go, well, I don't have that or that.
Yeah.
Now what, right? So there are ways to accomplish what you want to accomplish, to get that done. So I just wanted to make sure everybody, knew that when it came to agency, as well. So other questions? Any other questions? I'm sure you got something for Trey. But,
Other asset classes.
Yeah.
Just multi, but student multi, senior living multi, healthcare multi, conventional and affordable multi, but all housing.
Oh, just housing.
Just housing. Yeah, and now anecdotally, the agencies are now doing BTR programs. So SFR for BTR.
What's that?
Build to rent for single family.
Agencies doing that?
They are now. Yep. Yeah, we have a bridge product for it too. So it's an interesting little run.
So let's talk about that.
Oh, BTR?
So well, not that, but let's talk about, bridge, and then you hear people talk about mezzanine debt. What is that? What are those?
Yeah, so bridge financing is if you're looking to acquire a value add program or a value add asset,
Right,
or we're doing a lot of lease up assets too. So that's another thing that I've been doing a lot of. Not a lot, but some of it's Class A multifamily that developers have built that they cannot sell because there's no market to sell at what they need to sell for, or they're long-term owners, but they had construction delays. This is a very small audience, so I should probably. But then value add. So if you're taking over one of these, we are still active as a lender in the value add program, which is when you're taking over a Class B and converting it and trying to take it to a B+, A-, or taking over a C+, high leverage value add bridge financing. We didn't have a whole lot of exposure. We're a startup. Well, not a startup, but we're a well-funded startup that we weren't around in 2020 and 2021 and very little of 2022. So we're still doing value add bridge financing, and if you're looking at those transactions, those are good. But bridge is when your deal doesn't yet qualify for agency debt, but you want to acquire it, work a business plan, get it ready for agency debt. We provide the capital to do that as well. And it's a proprietary balance sheet product, so it's all our own money, and we have a lot of it.
All right. What about mezzanine?
So mezzanine is just, it functions a lot like pref, but essentially it's just a way to go higher up in the stack. And the agencies aren't really friendly to mezzanine debt unless it's their own mezzanine debt, which they do offer. But pref is the biggest thing, right? Everybody talks about pref. Pref is the biggest source of equity that isn't LP equity. And in that case, most pref groups are going up to about 85 to 90% LTC. Where they get constricted is they have to cover a 105 DSCR. And so if you kind of think about that sort of conceptually, when you're at a 105 DSCR, there's not a whole lot left for your LP or your GP. So these are long-term plays where you think that there's significant value add, and you're going to make your money on the back end. Biggest change in the pref world, something I think is interesting. Everybody doesn't know, but a lot of folks know that Freddie allows for hard pay pref. Fannie has announced in 2024 now, it's 2024, we'll start allowing for hard pay pref with a very unique asterisk. But that's cool. That's a good thing.
So that leads me to the next question I was going to talk about, or have you explain, is what's the difference between Fannie and Freddie? What's the advantages of one over the other, or disadvantages?
There's a little bit more of a delegated model with Fannie. In other words, we get a lot more decision making with Fannie Mae. It's our own credit parameters. We take on a lot more loss share. We take on a lot more risk. Freddie is a glorified broker model. But if you have a strong relationship with your Freddie production, that can be very beneficial. By and large, the two sort of operate similarly, but are constantly searching for different assets, different sponsorship, different food groups. So at any time or more, one of them is typically a little bit better than the other. Both agencies were recapped for $70 billion this year, so both agencies have $70 billion to deploy. And the Biden administration probably, if we were for some reason to break out of $70 billion, the Biden administration would likely grant more. So I think they're both extremely well capitalized this year. They have a lot of money to deploy, and they kind of start off the year in equal footing. But as one does a little bit more, maybe the other drops their rates a little bit, and they try and balance. Go ahead.
You mentioned the amount that they can loan out.
Mm-hmm.
Have you seen, which president? Basically, what I'm getting at is if Trump was elected,
Yeah.
is that going to increase the amount y'all can loan next year, or do you see that?
No, so actually under the Obama administration, it was $100 billion. The Trump administration was the first administration to try and remove Fannie and Freddie from conservatorship. The FHFA chair that he appointed, the HUD chair that the FHFA chair appointed, which is appointed by the president, the HUD chair was adamantly in favor of removing both of the agencies from conservatorship. But even he, who was probably the most publicly announced person in the sphere to be wanting to remove it, even he said this is a 4 to 8 year endeavor. Generally speaking, without talking about politics, you'll probably find that the Democrats more favor keeping Fannie and Freddie in conservatorship, and the Republicans favor getting them out of conservatorship. That said, I think it's all posturing. I don't think that there's a route to remove either of them. And it's a mega cash cow for the American taxpayer. And they probably don't love all this words that I'm saying, but the reality is they're probably not coming out of conservatorship, and I think they know that, right? I don't think that that's really crazy, but to that point, I don't think either administration would limit the amount. I don't know, maybe, but I don't see why they would. There's a lot of lobbying to get higher, and it's pretty. I mean, they work as their delegated duty from Congress or congressional delegation. Am I saying it right? I don't know, but their delegated duty is to provide liquidity in the housing market. And for all we can talk about Fannie Mae and Freddie Mac in the multifamily housing market, it doesn't even begin to scratch the surface of their performance in the single family market. They're basically every loan, right? Like if you're buying a house, it's probably Fannie Mae or Freddie Mac. And they're something like 60 to 70% of every multifamily housing loan. So they have a profound market share, and they're not beaten. I mean, just kind of to my point earlier, is like, we are the best financing, and that's not me posturing up here for sales. we are, as long as we want to be, we're going to win the transaction.
Yeah. So when somebody brings you a deal, I know when, I'll bring you a deal and say, can you quote us on this? You always send us a quote that's either Fannie, you send a quote Fannie and Freddie.
Yes, so I try and usually make a guidance on which one I think is going to be better.
Right.
And then if I think that they're going to be more or less pari passu, then I'll quote both. But to be frank, I've never opened an Excel model in my life. I have no idea how computers work. But I have a really good team of analysts, and they crunch away at it and build workbooks and stuff.
Yeah.
I just Instagram a lot.
Pat.
Yeah, Fannie and Freddie are for capitalizing the rental real estate market, commercial for housing. Is there such a similar program for commercial real estate? As in,
like a government sponsored?
Yeah.
No, and well, maybe. I think SBA might actually be. I don't know if that's government sponsored or not, honestly. But I think the reason that they're so government focused is because they are housing, right? And they always had a congressional duty. There's a word for it, and I'm not saying it right, but a delegation. But it was post 2008 that they got put under conservatorship. So the hyper control, like the idea that the HUD chair appoints an FHFA chair, and the HUD chair being appointed by the president. So basically, complete government control over telling them, here are your credit parameters that you can lend on, and here's how much you are allowed to lend. At this point, I don't know how it's not government agency, because under their conservatorship, the government backs. Goodness gracious. All right, Fannie and Freddie exist as they are not actual capital sources. This is like a crazy thing about this whole thing, is that Fannie and Freddie aren't actually providing the money. What they're doing is they are delegating someone like us to come in and make a market for a bond that we then subsequently take out to the commercial market and sell, typically to like a BlackRock or a Goldman Sachs or a JP Morgan, or more than likely, if you have a 401k, you're holding the paper that I'm selling. And the agencies exist as a backstop, as a guarantor for if that bond ever goes bad, the investor, aka you, aka Gold, whatever, whoever bought the bond, they get compensated by the agencies. So the bond is considered basically no risk, or a slight risk premium above the financial theory of a risk-free rate. And that's why we are able to be so much more competitive. So, kind of to that point, there's not a world in which I think that the government's going to let that power go, if that makes sense. Or the opportunity to make money off of it, because they make considerable amounts of dollar bills off of just guaranteeing that it won't go bad.
Okay. Any last question? Tommy's got another one.
He had regarding the experience for the agency, does that mean that he would have to sign on a loan, or is being a member of the GP sufficient?
Being a member of the GP is sufficient, but really what it is, and it's also it's narrative based, right? So what it really is can you point to the fact that during the ownership of that asset and the operational control of that asset by your general partnership, that you had decision-making capability, that you performed on your decision-making capability, and that the day-to-day discussion of, are we going to replace this refrigerator? What color are we going to paint these units? Are we going to do cabinets here? Are we going to turn this door or not? All of that, you were part of that active discussion. That's the experience that they want. So it's really, there are some times where people are like, well, I have LP experience. And I'm like, I have 1,500 doors of LP experience for $5 million, right? Like, that's nothing to goof at, right? That's great. But were you in the trenches every day making the decisions for that property? That's what they're asking. So it's more of a narrative than it is yeah.
Yeah. So, all right. So has this been educational?
yes.
Everybody know where they want to go in 2024? Right? First you call me, and then I get a hold of Trey. I'm just kidding. But I'm not kidding. But yeah. Right. So, but anyway, Now you can see why you want to, so I can see my shoes. No, so the I knew I was going to have to compete with Trey, so I got the right shoes up here today. Anyway, now you can see why I wanted to have Trey as our first speaker to start off the year, just because of his knowledge. If I have any questions on agency, I just have Trey on speed dial. and give him a call, and he always answers. I'll also tell you that if you ever do agency, when I would tell him, hey, I've got this client that they're insisting that I have to send this deal to a couple of different agency lenders, Trey has never been beat yet. So I'll just, from my experience, yeah, he's gonna win the deal, whatever it takes. I mean, legally,
yeah,
whatever it takes. But he will. I mean,
no, I'm kidding.
Yeah,
I'm kidding.
But yeah, so he's a great resource. So how do people get a hold of you?
Well, let me say something nice about you first.
Oh.
So I graduated college. My story's public online, so I don't mind it anymore.
Yeah.
But
Auburn.
yeah, well, I was so I grew up homeless, and it was not so much fun. And there was an English teacher in high school that pushed me to go to college, and I went to college, and I became very serious about doing well in college, and I tried to, at least in between all of the bar visits. But I graduated. I was a trader for the Swiss bank for like I don't know, a year and a half, something like that. Didn't fall in love with it. Went into mortgage brokerage for another year and didn't fall in love with that. But I wanted to get better at, I didn't fall in love with mortgage brokerage because I didn't feel like I could add as much value to people inside of the housing market, which is what I've always cared about, is just housing. And so I didn't want to be a mortgage broker anymore, but I knew that I had found like what I fell in love with. And so I wanted to learn more about it. I went to this like, I don't know, with the licensing thing or whatever, certificate almost, but it was called CIM. And I did their first class there. And when I was there, I sat next to a woman while I was my first day, and she was one of the nicest people I'd ever met. And I think she knew that I was just scared to be there and wanted to talk to me. And that woman was Jana Truman. And I, in that first week, just loved Jana, and she introduced me to Brian. And the first time I ever met Brian, I knew that I had met probably the most honest person in our entire business, which is this business is full of a lot of eccentricity and a lot of really smart and a lot of really fun people. But to meet someone that's as genuinely, morally, ethically, and just humanly sound as Brian is a real treat. And I did my very first deal with Brian and Jana, and I've closed around $1.1-ish billion since then, and we've sprinkled in as many opportunities as we can between that, and it's been wonderful. So I've always thought very, very highly of the Trumans, and I speak at very few events, but never say no to Brian.
Yeah.
So,
yeah, I appreciate that. And that very first deal Trey and I did was with Pat Sullivan, who's sitting in the audience.
Yes, it is.
today.
Yeah, yes, it is.
Yes, and he still owns that property today. So, yeah. So, but anyway, so we appreciate everybody coming out today, and certainly grab Trey's information before he heads out, and then if you miss him by chance, just let me know. I can get you his information from that. But we'll be back again first Thursday in February, right here, and for a real treat, I'm going to be the speaker next month. So, just so you know. So I'm going to talk to you about how to work with a broker, right? Because a lot of people, for some reason, think we're really scary, and as you can see, I'm not that scary. So from there. But anyway, first Thursday. We'll see you back, but appreciate you coming out again, and have a great 2024. And I think it's I'm like Trey. I'm very bullish about 2024. I think it's going to be a great year. I'm just telling everybody hang on to their seat, because I think it's going to be a little bit of a wild ride. And Trey told me to go get another battery for my cell phone because it was going to be ringing off the hook. So I'm going to take his advice and go. So thanks everyone, and have a great rest of your day, and appreciate you coming out.
Thank you, buddy.